going on around the country with regard to some controversies? What are the decisions taken by the High Court and why that has been taken in a particular situation? However, analyzing it in a broader sense shall not be possible today, considering the paucity of time and the amount of controversies that has been decided around the country in recent times. So what my idea today is to share it with you all, what is the controversies as well as what are the decisions and why such decisions have been taken, rather than discussing on the critics of it. With this, the first judgment which I shall take is with regards to the definition of capital asset. Capital assets have been defined under the Income Tax Act under Section 2, Clause 14 of the Act. Why? Our Income Tax Act functions in a manner that all the regular receipts are considered as suo motu income. Let me elaborate. If I am doing a certain activity on a regular basis, every money that I earn out of that activity is technically taxable. What is not taxable is a capital receipt. However, capital receipts are brought in specifically under Section 45 of the Income Tax Act, which taxes the gain out of a sale or transfer of a capital asset. There has been a lot of controversy with regards to sale of an agricultural land. The first judgment deals with such a situation. For example, if I have a property which is recognized as an agricultural land in my revenue records, selling of it, if it is falling within the definition of Section 214, is not taxable per se. The reason behind that is the power of central government to tax an agricultural income. Under the Constitution of India, that role is only provided to a state government. That is the precise reason why Income Tax Act negates all such receipts with regards to agriculture, because that is the sole domain of state government. However, if that land is not an agricultural land, central government gets the power to tax such receipts. Capital asset defines agricultural land in a particular manner. That has to be looked into in each and every facts and circumstances. However, the controversy that I'm dealing right now is with regards to characterization by the revenue records. It may happen that your land, which is an agricultural land, has been converted to a non-agricultural land just for the purpose of selling it. We all know that an agricultural land can be sold only to an agriculturist around the country. However, if some agriculturist need to sell that land to a non-agriculturist, he has to first convert that land from an agricultural land to a non-agricultural land. Specific provisions are Section 65 of Bombay Tenancy and Agriculture Act, which deals with the conversion. The government collects a certain amount for converting it, lays down certain conditions which needs to be fulfilled for getting that permission. A issue thus arises when a farmer sells his land. Despite he being using that land for the purpose of agriculture, he may have to pay taxes just because he has converted that land to a non-agricultural land for the purpose of selling it. There have been numerous judgments which you will find wherein the courts have decided a particular issue which is something like this. that if my land, which is characterized as an agricultural land in the revenue records, but it is not being used for the purpose of agriculture, then government taxes the sale of such lands. They are characterized as a non-agricultural land, going out of the definition of the agricultural land provided under the Act, and thus becomes taxable under Section 45. This is the reverse scenario. My land is converted into a non-agricultural land just for the purpose of sale, but it was being used for the purpose of agriculture till the point of sale. The issue arose before the ITAT Ahmedabad. The Honorable ITAT was kind enough to treat such land as an agricultural land and held that if in such scenario something like this happens and the agriculturist is using the land for the purpose of agriculture till the point of sale, that land cannot be taxed under the provisions of Income Tax Act. Ultimately, they have allowed that claim of the SAC on the premises that it is not sure that the buyer, who will ultimately be enjoying the fruits of that land, will meet the conditions pointed out by the collector for the purpose of conversion. It may happen that he may not fulfill, and thereafter just the non-agricultural land will again be treated as an agricultural land for the purpose of revenue. The said ratio led to this decision, the first decision, Teja by Nagji by Makwana versus ITO. This is a latest judgment, 2024. It is highly controversial at this point of time. It shall be tested before the higher courts. But nonetheless, we have something throwing light on such an issue. The next judgment is with regards to the latest controversy going around the country with regards to trusts. A lot of participants who are practicing in income tax today may have faced rejection of registrations solely following the judgment of Honorable Supreme Court in the case of Dawoodi Bohra. Dawoodi Bohra dealt with a situation wherein the deed of a trust, not entirely, but some part of it, the objects of it targeted only a particular religious community. Section 13 of the Income Tax Act states that if I apply my funds only for the benefit of a particular caste or a religious community, I am not eligible for Section 11 exemption. However, the question arises, at the time of registration, whether an assessing officer or CIT exemption, which is an appropriate authority in such cases, can go into that aspect of Section 13. The process of registration goes like this. An SSC trust shall apply for registration under the Income Tax Act. The sole criteria to allow that registration is on this basis that the authority has to look into the objects of the trust, whether such objects are charitable in nature or not. That is the only criteria. The question thus arises, whether Section 13 can be invoked in order to cancel a registration at the time of application. The first implications. recent judgments is in the case of Parul University Association, which has ultimately followed the judgments delivered in the old trust laws. The old trust laws and the judgments reflected such situation, and it dealt it in this manner, that the appropriate authority at the time of granting the registration is not supposed to look at the application of funds. It may be for X, Y, Z community that has to be looked only at the time of assessments. If such a violation of is found, which is provided under section 13, the assessing officer may write a representation to the commissioner that look, this trust is working for a particular community and this trust deserves rejection of registration. At the time of the first instance, that is applying for the registration, CIT cannot go into the aspect of section 13 of the Act. He cannot, he has to just look into the objects of the trust. If some of the objects are charitable in nature, he has to allow my registration under section 12AA. That is ultimately been held in Parul University Alumni Association versus CIT and other judgments. Both of them are IT/AT Ahmedabad, because I follow every judgment delivered by IT/AT Ahmedabad. This is the best source. However, I am aware that IT/ATs around the country have followed the ratio, and you will find numerous judgments on this issue now. This will solve a lot of problems in case of new registrations which have been cancelled by the income tax department. The next judgment deals with a situation with regards to exemption that an SSE claims under section 54 of the Act. We all are aware that if I earn a long-term capital gain, and if I am an individual or an HUF, I am eligible for exemption under section 54 of the Act if I invest it in a new residential property. Timelines and everything has been provided by statute. However, a lot of time it may happen that an SSE may buy a property which may not be habitable. When I say habitable, के रूफ नहीं होगा या कुछ प्रॉब्लम होगा, मैं रह ही नहीं सकता उस प्रॉपर्टी में. The question arises, if I expend something on that property to make it habitable, whether that shall be considered for exemption under section 54 of the Act? The answer is yes. The latest judgment is in the case of Sapna Himanshu Shah, delivered by Bangalore Tribunal, wherein the SSE Sapna Shah, at the time of purchasing the property in a composite agreement, also paid towards the interior of that property. Ultimately, IT/AT held that such expenses done by the SSE in order to make the property habitable is allowable under section 54 of the Act. It may have been done, may not have been done in a composite agreement, but my view is, because it is being done to make it habitable, this is an allowable expense and an allowable exemption under section 54 of the Act. The next judgment again deals with the exemption under section 54 of the Act, 54F of the Act. 54F is a similar provision. However, 54 deals with resident when the long-term capital asset is a house property, whereas 54 deals with any long-term capital asset. For example, if I sell a long-term capital asset and if I buy a residential property, it is covered under section 54F of the Act. The controversy that I want to discuss herein is that whether I have to register my title documents also within the time limits provided under section 54 of the Act. The time limits of section 54 are this wise, that if I want to buy a property, it can be bought at least before 1 year of the transfer of the long-term capital asset or within 2 years after the transfer of the long-term capital asset. What happens if I fail to register the document or the sale deed which suggests the purchase of the property? Recently, ITAT Rajkot had the occasion to deal with such a situation and they have decided the issue against the SSE. ITAT Rajkot stated that because the title is still not in your name, when I say title, I'll be very clear, it basically means reflection of my name in the revenue records. So what ITAT Rajkot stated is this wise, that if you do not register your document within the time prescribed under section 54 of the Act, you are not eligible to claim exemption under section 54 of the Act. The law as regards registration of document is challenged in numerous cases. It may happen that SSE may have registered the property in the name of his relative. Courts around the country has allowed such an allowed exemption under section 54 of F of the Act in such circumstances. I really don't understand if a title, if in a situation I have in fact not registered title in my name, the courts have allowed on the premises that what is important for section 54 of the 54F of the Act is this, that I must have invested in a new residential house property. Just because registration has not taken place within the particular period of time, how can it, I really don't understand how can that be disallowed? While delivering the judgments, I was going through this judgment, tribunal has simply analyzed 54F without going through the binding jurisdictional high court judgments. My jurisdictional high court in the case of Kishore Bai 417 ITR 547 has allowed 54 exemption in the very said circumstances. In my humble opinion, registration is not so important because the provisions of section 54F of the Act allows exemption on investments, not on transfers. If I invest, if I am in a position to show it to the assessing officer that look, these are my bank statements, look at these bank statements, I have already made payment. Due to XYZ reasons, the registration of document has not taken place. However, that does not mean that I am not invested in the property. I have all the requisite documents which suggest that I have invested. In such situation, 54F has to be allowed. Registration of documents may not be sine qua non looking at the overall circumstances. The next judgment deals with a burning issue around the country which has started after the demonetization. During the course of demonetization, we all are aware 8th November से 31st December, डिमोनिटाइजेशन हुआ था उस टाइम पे लोगों ने कैश डिपॉजिट्स करवाए थे. A lot of SSEs claimed that look, मैंने सेल किया हुआ है कैश में and the source of cash deposited in my bank account is out of sales. But assessing officers on the basis of presumption and surmises around the country in a same modus operandi have disallowed such explanations, stating that के last year तो आपने 100 रुपए का सेल किया था, अभी आप 150 दिखा रहे हो, ये 50 रुपया बढ़ा, मतलब ये 50 रुपया जो है वो तुम्हारी इनकम है, और क्योंकि मैं पूरा बुक्स ही रिजेक्ट कर रहा हूं तो ये 150 की 150 तुम्हारी इनकम है. Recently, in fact, Ahmedabad Tribunal, Bombay Tribunal have, in facts and circumstances again, have found that if SSE is in a position to demonstrate that or to prove that these receipts are nothing else but his sales receipts, and he has provided all the documents, the explanation provided by the SSE cannot be rejected on the basis of presumptions. कि लास्ट ईयर इतना हुआ था, इस बार इतना हुआ है. Things don't work like that. However, one step ahead, ITAT Delhi has in fact found that how can sales be added under section 68 of the Act? We all are aware that section 68 deals with a situation wherein some sum is credited in my books and I am not able to explain the source of it. But what about those receipts which has already been offered as income? Section 68 is a deeming fiction. It says कि अगर आप प्रूव नहीं कर पाते हो कि पैसा कहां से आया है, this is deemed to be your income. But what about those receipts which has already been offered as income? Delhi Tribunal has come very hard and stated that sales cannot be added under section 68. In fact, before assessment year 17-18, before the introduction of provisions of section 115 BBE of the Act, which taxes a particular receipt which has been added under section 68 to 60D of 69D of the Act, it taxes at maximum marginal rate 60%. This is what they say. But before introduction of this provision, Gujarat High Court, Bombay High Court, and other high courts have already held while deciding the issues that sales can never be added under section 68. Tribunals around the country have already started delivering positive judgments, but this goes one step further. Herein, it has been held that sales cannot be added under section 68 simply on the premises that sales are already offered as income. The next judgment deals with the evidences which leads to addition under section 68 to 69D of the Act. Such evidences such as digital evidences, usually found at the time of search in case of a search party. कोई एक्सेल शीट मिलेगा या व्हाट्सएप इमेज मिल जाएगी suggesting some conversation with the SSE with regards to money trail. What is the characterization of such an evidence? Digital evidence है, WhatsApp image है, Excel sheet है. Under the law, such evidences are covered under the definition of documents as per Information Technology Act. It is a document. However, such loose documents, in absence of any corroboration, I'll explain what is corroboration. For example, assessing officer finds a loose working of on money received by the builder. However, it does not find any acknowledgement of it in the form of physical evidence. For example, if I pay something to the builder, I will necessarily do it in writing. भले ही वो मैं बुक्स में दिखाऊं ना दिखाऊं. It can be a साताघात. It can be a loose sheet wherein my signature is taken. The law as regards to dumb documents is already settled. That a document which is not corroborated through something concrete by the assessing officer or by the investigation wing or by the income tax department as a whole, such documents cannot lead to any addition. But the controversy around the country after 15 and 16 has been all the documents are now electronically prepared and all the data are electronically fed in a computer. If assessing officer or the search party finds that document or de-encrypts it, whether that can lead to addition in the case of a third party. The answer to this question is that until and unless assessing officer does not corroborate that Excel sheet or a WhatsApp evidence with something concrete, solely on the basis of such electronic evidence, no additions can be made. This has been held by Surat Tribunal in the case of ACIT versus Shakir Nebumal Uttam Chandani. In fact, in an unreported judgment before the High Court of Gujarat, similar issue was being carried out and Gujarat High Court has already held that such documents solely cannot be relied to make addition in the case of a third party. I'll share that judgment with the participants after this because I just now recollected that not just Surat Tribunal, but now Gujarat High Court has also come on this issue. They have already decided this issue. Nonetheless, the next judgment is with regards to cancellation of registration under section ETG solely on the premises that the applications were being moved belatedly. After the change of law, in case of trusts, we may be aware that certain time limits were being provided to the SAC within which they were supposed to file their applications, provisionals as well as final. However, on account of technological issues, everything was supposed to be done electronically. Due to technological issues, a lot of trusts could not meet that requirement. CBDT came with an extension from time to time. However, the last notification extending the time limit was notification number 6 of 2023, circular number 6 of 2023. Inadvertently, CBDT failed to cover the issues of section ATG application. It only covered the partial situations. Few of the situations are covered. However, that circular was not covering the entire controversy. Because most of the SSCs were not covered by that circular, department started rejecting such registrations under section ETG. Recently, CBDT has come up with a fresh circular number 7 of 2024, which now covers the entire gamut. However, most of the SSCs have now preferred appeal before the IT-AT as against the rejection of their registrations. In all such cases, IT-AT is not now following the process of remanding all such matters. Circular number 7 also provides that if your application is rejected solely on the premises that it was being belatedly filed, you can also apply for a fresh application. So now the assessees have two situations. They have two options available with them. They can either file fresh applications or they can also get it done through Income Tax Appellate Tribunal. However, the orders rejecting my registration on this count is not allowed. This judgment, I picked it from Delhi High Court and it was with respect to GST department and their actions. However, laws are interlinked. Laws such as principles of natural justices, it may have been delivered in some other law. It may have been delivered in GST, but they are equally applicable to the income tax proceedings as well. Because the fundamental principles of procedure remains the same. Because this deals with a specific situation of procedure, I have covered this judgment as well. We all are aware that now all the assessment proceedings are being carried out in a faceless manner. The specific section which deals with the faceless proceedings is section 144B. Section 144B mandates the assessing officer to issue a show cause notice. In turn, the assessees are expected to file their responses. And after considering the entire material submitted by the assessee, the assessing officer are required to pass an assessment order, either accepting the stand of the assessee or reiterating the additions that were being proposed in the show cause notice. However, we all must have faced that the assessment orders do not consider the reply of the assessees. What is non-consideration, however? He may not have even reflected your reply while framing the assessment order. That is a clear-cut case of non-consideration of reply. He may have stated something like this, that I have considered your reply, but it is not found satisfactory. What is expected out of an assessing officer is this, that he is supposed to check all the objections, all the material, and he has to deal with each and every objection raised by the assessee while filing the reply. He cannot simply write that I do not find it satisfactory. He has to deal with the situation, he has to deal with the objection, and by way of a speaking order, he has to jot it down his mind as to why it is not satisfactory. If this process is not complete, such a situation shall lead to violation of principles of natural justice, which has ultimately been held by Delhi High Court in the case of AB Traders versus CDGST, Commissioner of Delhi Goods and Service Tax. However, this judgment will also apply to the provisions of section 144B of the Act. Such an order can be challenged before the Honorable High Courts on the wise of principle of natural justices, and you may get immediate justice on such matters, because the courts are now flooded with such issues. And courts have now decided that if we come across such issues, we will be deciding it immediately. So this was the judgment with regards to 144B. The next judgment also deals with section 144B, however, in a different fashion. We may have come across a lot of show cause notices. Show cause notice may provide certain time to the assessing officer, assessees. It may range from 7 days to 15 days. Some assessing officer does not even provide couple of days to respond. CBDT, when the faceless assessment proceedings were being brought, came out with a standard operating procedure, which mandates the assessing officer to provide at least 7 days time to respond to the show cause notices. However, despite there being such clarity issued by the CBDT, assessing officers most of the time do not provide either the requisite time, adequate time, or the opportunity of personal hearing. My view is, if a show cause notice does not provide at least 7 days time, such show cause notice is not valid under the law. Courts around the country have come to this conclusion in a factual circumstance wherein 3 days or 4 days time were provided. My view is, if the assessing officer does not provide at least 7 days time, the assessing officer is violating the standard operating procedures issued by the CBDT and in turn the provisions of section 144B, and any order passed by the assessing officer violating such a condition is not good in law. Recently, Sutherland Global Services Private Limited versus DCIT has held so. It may not be 7 days time, it may be 3 days or 4 days, but CBDT SOP suggests that it has to be in compliance with it, and the compliance is guaranteed only if you provide at least 7 days time. My view is this is the norm. Ultimately, when the CBDT SOPs will be shown to the courts will also held so, because ultimately any direction, instruction issued by CBDT to its officer is mandatory. The officers cannot take any stand against those instructions. The next judgment deals with section 147 of the Act, read with the provisions of section IBC, Insolvency and Bankruptcy Code. It is this judgment is interpretation of both the codes, Income Tax Act as well as Insolvency and Bankruptcy Code. The situation is this wise. If a company is taken to National Company Law Tribunal under section 7 of IBC, and after the entire process, NCLT grants the allowance of section 7 application. Section 7 application is basically when the corporate debtor does not pay its debt. In such circumstances, IBC provides that the management as well as the company has to shut down its operation. However, an option is provided if there is a buyer of that company to continue with that the operations of the company. But what happens if the NCLT allows the application and settles all the past dues, and income tax department comes out with a fresh claim on the premises that they have detected some escapement of income after the resolution plan has been accepted by the NCLT? What should be done in such a situation? Ghanshyam Mishra and Sons is one such case which ultimately traveled to Supreme Court. And Supreme Court devised a law, or after interpreting the entire code, that look, the entire idea of IBC is the continuous operation of the said company. It should be debt free. If a buyer is saying that I am ready to pay such amount, he should not be fasten a fresh liability after the resolution plan has been accepted. Dealing with such a situation, Bombay High Court, Gujarat High Court came up with an issue. Okay, what happens if after the resolution plan is accepted, income tax department finds out a fresh escapement of income with regards to the old periods? Bombay High Court as well as Gujarat High Court ultimately held that look, whatever that has gone has now gone. You cannot fasten a fresh liability on the new buyer. You have to let go of all your past dues. The principles that has been laid down is this wise, that when the process of resolution plan is going on, the income tax department is supposed to also raise their own claims. If some claims has not been raised by them, or if they come across a fresh claims, they have to let go of all such claims. The next judgment deals with the doctrine of merger. Under the old law, old 147, there was a special provision with regards to the merger, with regards to doctrine of merger. What is doctrine of merger? Doctrine of merger functions in this manner. Let's just for an example, assessing officer passes an assessment order. That order is now challenged before CIT appeal or a higher appellate authority. Once a higher authority decides that issue, the order of the higher authority merges with the assessment order, and it now becomes the order of the higher authority. The order of assessing officer goes. In India, separation of power is utmost important. It is a well accepted principle. The said principle was embedded in explanation 3 to section 147 of the Act, the old one, which stated that if a higher authority decides on a particular issue, then assessing officer cannot reopen the same issue on the premises of some mistake. That principle was well accepted under the old law. However, this explanation is not added in the new one section, section 147 of the Act. What happens if tribunal decides an issue on a particular period of time, and assessing officer finds that, look, our tribunal has committed some error this wise, and I want to reopen this issue. Firstly, that is not possible under the new law on the basis of Bombay High Court judgment, wherein they have ultimately held that, look, if you have decided a particular issue at a particular period of time, you cannot change your opinion. However, if he finds something new, a fresh information, suggesting that the tribunal's order is not correct, what has to be done in that situation? My view is, once tribunal decides a particular issue, it is not open for the assessing officer to reopen the same issue. The principle behind that is doctrine of merger. Even though section 147 new does not provide for the said doctrine, does not protect the SSC in such a situation, the SSC shall still be covered by the doctrine, and they can simply challenge that order before the high courts or before the appellate authorities at the relevant point of time. The judgment that I am referring to is Poonam Builders versus ACIT 162 Taxman.com 238. This deals with the old law. However, in my opinion, this shall also apply to the new law. We all may have come across situations wherein the SSCs are served with notices on the basis of third-party investigations. Third-party investigations means investigations carried out by GST department. It can be ED. It can be any third-party investigating agency. Assessing officers from time to time receive such information that XYZ is involved in accommodation entries and your SSC is involved in taking bogus billings. In maximum number of notices that I have come across, the peculiar circumstances is this wise. The assessing officers never apply their own mind. They simply rely on the tips provided by the other agencies. They will reproduce the entire investigation report in their notices. However, they'll not come to a conclusion as to how it affects their own SSCs. That the notices, basically, notices. As per provisions of section 148A, clause B of the Act, the assessing officers are bound to issue a show cause notices. Show cause notices are not mechanical exercises. The assessing officer has to apply its own mind. They have to also consider the tips, the materials that they have received. They cannot simply rely on finding provided by a third party agencies. Such an exercise is embedded in the word show cause notices. Before show causing the SSCs, the assessing officer should first himself be convinced that there is an escapement of income. If he is simply relying on a satisfaction drawn by a third party agency, the mandatory provision or the mandatory condition of application of mind while issuing the show cause notice is not fulfilled. Let's imagine he issues a show cause notice and I furnish a reply explaining the entire situation. In the given circumstances, let's imagine that assessing officer receives an information that I have taken accommodation entries in the form of bogus purchases. He relies on a particular material. I furnish the explanation that, sir, you may have received that tip. You please provide me that tip. But in my books, these purchases have been recorded and ultimately being sold. I also attach e-way bills, delivery challans, everything, which proves the movement of goods and the entire gamut behind the transaction. Section 148A(c) of the Income Tax Act says that the assessing officer has to consider that reply. He has to consider the evidences provided by the assessee, and he has to apply his mind. Such application of mind must be reflected in the assessment orders. He cannot simply write that I am not satisfied. This is not enough. He has to apply his mind independently on each and every material that he has received, as well as the material that the assessees provide, in absence of which the order passed under section 148A(d) of the Act shall be illegal. This is ultimately being held in the case of KEC International Limited versus Union of India. This judgment was delivered by Bombay High Court. I have also provided the writ petition number. Someone may after writing this on Google, you will also get this copy of judgment reported on Indian Kanun or something like this. The next judgment deals with sanctions granted by Principal Commissioner of Income Tax or Principal Chief Commissioner of Income Tax under section 151 of the Act. 151 of the Act mandates that before the issuance of notice under section 148, the assessing officer has to accord sanction from the higher authorities. It may be PCIT, it may be Principal Commissioner of Income Tax. However, what all exercises have to be carried out by such higher authority is dealt with this judgment. Vodafone India Limited versus DCIT. You may have come across a lot of sanctions wherein the Principal Commissioner of Income Tax may write that I am satisfied with the exercise carried out by the assessing officer, and I am also satisfied that assessing officer is in possession of such information which suggests escapement of income. However, the interesting point is you will find same narration in all the sanctions. If all the sanctions have the same wordings, how does it prove that there is application of mind by the Principal Commissioner of Income? The entire exercise of section 151 is to avoid the excessive powers, exercise of excessive powers by the assessing officer. That is to curtail their powers. Principal Chief Commissioner of Income Tax is supposed to apply his mind, and he has to look into the entire material and come to a conclusion that, look, 48 is required in this case. Or he has to also conclude that, देखो sir, इसमें कुछ नहीं हो सकता है. The entire exercise that you have carried out, the assessing officer has carried out, is not satisfactory. This is the precise reason why Section 151 has been brought into the Act so as to curtail the excessive powers. However, it is found that Section 151 sanctions have been accorded mechanically. One of the grounds to challenge such sanction is mechanical accord of Section 151 approvals. One of the grounds to challenge for Section 148 notices is this. However, how do you prove that there is non-application of mind by the Principal Commissioner of Income Tax? The classic example can be in support of other grounds. For example, if some fundamental factual aspect which suggests that there is no escapement of income, it is a clinching evidence that there is no escapement, assessing officer passes an order and sanctions are accorded to such notices, you may take this stand as well. This is an additional stand, a legal stand in addition to other legal grounds. That these sanctions accorded by Principal Commissioner of Income Tax is mechanical in nature. The next controversy deals with all the notices that have been issued under Section 148 of the Act after 1/4/2023. We all are aware that assessments have now been carried out in a faceless manner. However, Parliament also came out with an amendment in Section 151A of the Act. It brought a new law that now reopening is also to be done in a faceless manner. However, immediately after this, the territorial jurisdictional officer was issuing the notice under Section 148 of the Act. Now 151A is clear that all the reopening notices must go through the faceless exercise. And territorial jurisdiction now does not have any power to issue notice under Section 148. The first of the judgment in this context was delivered by Telangana High Court. It was ultimately held that after the launching of the scheme of faceless under Section 151 of the Act, 151A of the Act, the notice under Section 148 of the Act can only be issued by the faceless assessing officer. Calcutta High Court ultimately decided this issue against the assessees. They did not discuss the scheme. However, they ultimately stated that, look, CBDT in its own wisdom, who is empowered to administer the provisions of the Act, administer the collection of the tax, can regulate its own procedure. If CBDT decides that certain exercise has to be carried out by the territorial jurisdictional assessing officer, they may do it in their own wisdom. They can do it in that fashion as well. Calcutta decided the issue against it. Recently, Bombay High Court in the case of Hexaware decided the issue in favor of SSE, stating that after the introduction of scheme under Section 151A of the Act, territorial jurisdiction goes, the territorial jurisdictional assessing officer's power goes, and the entire exercise now has to be carried out by the faceless assessing officer. Hexaware will ultimately be challenged before the Supreme Court because the implication of this judgment is huge. On and around, Income Tax Department issues 15,000 to 20,000 notices every year. The impact of this judgment is huge because assessing officers around the country have committed this mistake. This will ultimately be decided by Supreme Court very soon, just like Ashish Agrawal, which was pan-India controversy. The next judgment deals with the limitation aspect. A lot of SACs who have gone through the litigations are facing this problem. Either they do not get the order giving effect to the appellate orders, or if the tribunal or the higher authority decides that the assessment has to be carried out afresh, what should be done? Section 153 of the Income Tax Act mandates that if a fresh assessment has been directed by the tribunal or the High Court, it has to be carried out within 12 months from the date of receipt of the order by the Income Tax Department, usually Principal Commissioner. However, most of the time, assessing officer fail to meet that deadlines. What are the consequences if they do fail so? The consequences are simple. The entire assessment goes. All the pending demands with regards to that assessment goes. If at all penalty, it also goes. The latest judgment in this case is, in this issue is Sunshine Capital Limited versus DCIT, Delhi High Court. Similar law has also been laid down by Honorable Karnataka High Court at United Spirits. And ultimately now the position is clear that the assessment goes along with the limitation. The next judgment deals with the accord of section in case of search assessments. That is to say, section 153D of the Act. Section 153D of the Act mandates that the assessing officer has to accord sanction in each assessment year forming part of the block. If you will call for such an approval from the assessing officer, most of the time, as you will find, you will feel surprised to find that the assessment of the sanctions have been taken in a composite manner. For example, they will mention all the assessment years, they will annex all the assessment orders, and they'll take only one single sanction for the entire block. Recently, Delhi High Court in the case of Shiv Kumar Nair has come to a conclusion that section 153D in its literal meaning requires separate sanction for separate assessment years. If no separate sanction has been taken, the entire assessment goes. This is one such shortcut, something new, not yet laid down anywhere, but this is a shortcut. After the conclusion of assessments, you may call for section 153D sanction through an RTI or through an application. And if something like this, if you may come across, you may quote this judgment or you may cite this judgment. We are all aware that earlier the penalty for concealment was being dealt by Section 271 1C of the Act. Section 271 1C is now being replaced by 270 capital A of the Act with effect from assessment year 17-18. 270 capital A has two limbs. The first limb is under-reporting of income and the second is under-reporting of income tantamounting to misreporting of income. Both are separately defined in Section 270 capital A. Misreporting of income has been defined in 270 capital A subsection 9 of the Act, whereas under-reporting has been generally defined under Section 270 capital A subsection 2 of the Act. However, what happens if the assessing officer issues a notice with regards to under-reporting of income? But while levying the penalty, he says, no, this is not just under-reporting, this is under-reporting tantamounting to misreporting of income. Whether such a penalty order can sustain under the law, under the old 271 1C, this law was settled that you cannot change the limb after the issuance of show cause notice. It is Gujarat High Court, Karnataka High Court, Gujarat High Court in the case of Manjunath Engineering, Karnataka High Court in the case of Manjunath Engineering, has already decided this issue under the old law. However, under the new law, Delhi Tribunal has now come out with this decision wherein they have ultimately held that, look, you cannot change your stand. You have to be concrete. I'll go one step further. If they write something in the assessment order with regards to the scope of the penalty, for example, if they write something in the assessment order that, look, your case is under-reporting of income, they cannot even change their stand later on while issuing the show cause notice under Section 270 capital A. They have to then go by this theory that this is under-reporting of income. They cannot later on change their stand. This judgment, the last judgment, deals with the criminal prosecutions. In the Indian law, in the context of criminal jurisprudence, mens rea, which is considered as intention to do the crime, is the most important thing. If you do not have intention to kill, you cannot be called a murderer. It may land up at different sections. Under the provisions of Income Tax Act, prosecution is provided for certain offences. This case dealt with the prosecution in those cases wherein an assessee files a delayed return of income. The section which deals with that is 276 C of the Act. It states, 276 C of the Act states that if I have intention and if I intentionally file a delayed return, I may be criminally prosecuted. Section 278 capital E of the Act state that intention is presumed in such offences. Presumed. This is a welcome judgment by Rajasthan High Court, that wherein it was found that after the trial, the assessee was succeeded in showing that he had no intentions, and thus there cannot be any criminal prosecutions in such cases. the Rajasthan High Court was also kind enough to deal with the provisions of Section 278 capital E of the Act. It negated that presumption has to be drawn only at the time of cognizance of offense and not at the time of trial and while delivering the judgment. With this, friends, this is the end of the session from my end. I am extremely thankful to GyaanStation Income Tax Bar Association for granting me this opportunity. I hope that I was clear. If you have any doubt, I'm ready to deal with any doubt with regards to this session. However, I shall be dealing with it electronically through email or through WhatsApp. Thank you very much.
Thank you, Mohit ji, for this wonderful presentation. There are few questions of the participants we would like to take up. Mohit ji?
Yes, ma'am.
Yeah.
Yeah.
So there are few questions which we can quickly take up in next few minutes.
Please.
Yeah. Can you please help to stop sharing the screen for clear visibility of the questions and all the participants also?